Welcome back to the deep dive. Today we're tackling something that sounds maybe a bit technical, review engagements in financial statements.
Yeah, it sounds dry, but honestly, it's fundamental to how we gauge trust and transparency in business finances.
Exactly. So let's unpack this. We're going to figure out what these reviews really are, how they work, and why they matter when you're looking at a company's numbers.
And what's really interesting, I think, is how this gives you a solid snapshot of a company's financials without, you know, the massive undertaking of a full audit.
The kind of sweet spot.
Pretty much.
Yeah.
It's a specific level of assurance, and we'll break down what that truly means.
Okay, mission for today. Distill this whole review engagement thing. Procedures, responsibilities, what kind of assurance you actually get. We'll contrast it with other services, make it super clear. You'll know exactly what that review label means by the end. So first things first, what exactly is a review engagement?
Okay, so think of it on a scale. It's definitely a step up from just like preparing or compiling financial statements.
More involved than just putting numbers together?
Right. But it's also deliberately less intense than a full audit. The absolute key phrase here is limited assurance.
Limited assurance. Okay, what does that mean in plain English?
It means the accountant isn't giving a thumbs up saying, yep, these are perfectly fair. That's audit language.
Got it.
Instead, they're saying something more like, based on our review, we're not aware of any major changes needed for these statements to follow the accounting rules.
Okay.
So it's not that everything is right, but more that nothing looks obviously wrong based on their specific work.
And how do they reach that conclusion? What are they actually doing?
The main tools are inquiry, basically asking management a lot of focused questions and analytical procedures.
Analytical procedures, like looking for trends and weird outliers in the numbers.
Exactly. Comparing current data to past data, budgets, industry stats, that kind of thing. Looking for things that don't quite add up.
Okay, so that already sounds quite different from an audit. What are the big things an auditor does that someone doing a review doesn't have to do?
Well, a huge one is understanding and testing the company's internal controls. The systems they have in place to prevent errors or fraud.
Right. Auditors spend a lot of time on that.
They do. A review accountant isn't required to go that deep into the systems. They don't assess control risk in the same way. And crucially, they don't give an overall opinion on the financial statements. It's just that limited assurance conclusion.
That's a massive difference. But I assume they still need to be independent, like no cozy relationships with the client.
Oh, absolutely. Independence is fundamental. It's mandated by uh, the statements on standards for accounting and review services. That's the rule book for these kinds of jobs.
Got it. Okay, so a company needs a review. How do they, officially start the process?
It all kicks off with a really important document, the engagement letter.
Ah, the paperwork.
Yes, but it's required. It sets out the understanding between the accountant and the client management, sometimes the board or audit committee. Its main job is just to make sure everyone's on the same page, avoid misunderstandings later.
Makes sense. What kind of details have to be in that letter? Is it just a quick note?
Oh no, it's pretty detailed. It has to lay out the objectives of the review. It spells out management's responsibilities, and that's a big list. Things like actually preparing the statements correctly, having good internal controls, preventing fraud.
So management can't just dump it all on the accountant.
Not at all. The letter also details the accountant's responsibilities. And critically, it highlights the limitations of the review.
Okay, like what?
It explicitly states that the review is substantially less in scope than an audit, and importantly, that no audit opinion will be given. It also identifies the accounting rules being used like GAAP in the U.S., and gives an idea of what the final review report will look like.
And everyone signs this, accountant and management.
Yep, signed by both. It's a formal agreement, really sets the stage clearly.
Okay, that clarity seems essential. Now, you mentioned earlier that the procedures aren't always the same, they're tailored. That sounds interesting. How does that work?
Yeah, it's not just a standard checklist they run through. The accountant really needs to get a feel for the specific business.
So understand their industry, their specific operations.
Exactly. They adjust their procedures based on things like how important certain financial items are, how likely errors seem to be, maybe what they learned from working with the company before, even things like how good the company's own accounting staff are, or how much management judgment goes into the numbers.
So if it's a complex industry, or if the company's records are a bit messy, the review might involve different steps.
Precisely. They need to know the industry's accounting norms and understand the client's specific setup, their assets, debts, revenue streams, expenses, get that overall financial picture.
But let's be clear on the flip side, too. What are the things they're specifically not required to do during this tailoring and understanding phase?
Right, this is key for anyone reading a review report. They are not required to test internal controls. That's audit territory. They don't perform detailed audit tests on transactions. They don't do a formal fraud risk assessment like an auditor would. And interestingly, they don't have to talk to the company's previous accountant, though they might choose to.
So the assurance is really focused on the numbers presented based on those inquiries and analytics, not so much the systems behind them.
That's a good way to put it.
But, okay, this raises a question. If they're not looking for fraud, what happens if they, stumble across something that looks really fishy?
Good question. They absolutely cannot ignore it. While the review isn't designed to detect fraud, if the accountant becomes aware of something suggesting fraud or illegal acts might have happened, they have a duty.
What kind of duty?
They have to consider how it might affect their review report,
Yeah.
and they need to push management to figure out how it impacts the financial statements. They can't just look the other way.
Okay, that's an important safeguard. So they tailor the plan, keeping materiality in mind, focusing on errors big enough to matter.
Exactly. They're looking for misstatements that could actually influence a user's decision.
All right, so the plan is set. They understand the business. What happens next? What are the core activities? The actual doing part.
This is where those two main tools come in: inquiry and analytical procedures. Let's start with inquiry.
Asking questions.
Right, but specifically asking questions of internal people. Management, finance staff, people inside the company who know about the financial side.
Not calling up their suppliers or customers.
Generally, no. That's more of an audit procedure.
Yeah.
The focus here is internal inquiries. And they ask about a lot of accounting methods, any big changes in the business, events happening after the balance sheet date, potential fraud they might know about, lawsuits, whether the company can keep operating.
Going concern, right?
Yep. Going concern, related party deals, significant transactions, any letters from regulators, the broad range.
And do they just take management's word for it? Or do they have to double check the answers?
Well, here's a key point. They're generally not required to find other evidence to back up every single answer from management. However, they do need to think about whether the answers seem reasonable and consistent with other things they know, that they can't just blindly accept everything.
Okay, makes sense. So that's the asking questions part. What about the analytical procedures? You mentioned comparing numbers.
Exactly. This is where they look at the financial data itself for patterns, relationships, and anomalies. The basic idea is to develop an expectation first, like sales should probably be up 5% based on last year and industry trends, and then compare the actual numbers to that expectation.
What kind of comparisons?
Oh, lots. Current year versus prior year financials. Actual results versus budgets or forecasts.
Yeah.
Comparing financial ratios to industry benchmarks. Even linking financial data to non-financial data, like production volume to cost of goods sold. Or digging into revenue details to see if trends make sense.
So if sales jumped 50% but production stayed flat, that might raise a flag.
Precisely. That's the kind of inconsistency they're looking for. If those analytical procedures show significant fluctuations or relationships that just don't seem right or contradict other information,
Then what?
then they have to dig deeper. They'd go back to management with more specific questions. Why did this happen? And might need to perform other procedures to understand the reason for the discrepancy. They can't just leave unexplained anomalies hanging.
Okay, so inquiry and analytics are the core. Are there other things they need to do as part of their review?
Yes, there are a few other important steps. They absolutely have to read the financial statements carefully to check if they seem to conform with the accounting framework, like GAAP.
Just read them top to bottom.
Pretty much, looking for obvious inconsistencies or departures from the rules. They also need to get reports from any other accountants who might have reviewed significant parts of the business, like a major subsidiary.
Makes sense, piecing it all together.
And they need to get evidence that the final financial statements actually tie back to the company's underlying accounting records. Make sure the numbers match the books, essentially.
And are there specific problem areas they need to keep an eye out for?
Definitely. They need to be alert for any related party transactions that haven't been disclosed properly. Those can sometimes hide issues. They also have to evaluate the work done by any other accountants or specialists involved.
Right.
And a really big one. They must consider that going concern issue. Is there substantial doubt about the company's ability to stay in business for the next year? If so, they need to look at management's plans to deal with it and make sure it's disclosed properly in the notes. That's a huge judgment call.
Yeah, that seems critical for anyone reading the statements. So, what if, during all this, the accountant finds something that genuinely makes them think the statements might be materially misstated, or the information they're getting seems dodgy?
If they become aware of something potentially causing a material misstatement, they can't just stop. They must design and perform additional procedures to get comfortable or figure out the issue. And if management provides information that seems incorrect, incomplete, or just generally unsatisfactory, they have to ask management to fix it or explain it.
So they have to follow through on potential problems.
Absolutely.
Yeah.
It's all part of providing that limited assurance.
Okay, this next piece sounds incredibly important. You mentioned it briefly, but let's dive in. The management representation letter. You said it's critical.
It's absolutely fundamental. You basically can't complete a review without it. It's a formal letter from management to the accountant.
What does it do?
It's management on paper taking responsibility for the financial statements and confirming a whole bunch of crucial things. It has to cover all the periods under review, be dated the same day as the accountant's report, and be signed by top management, usually the CEO and CFO.
Okay, signing on the dotted line. What kinds of things are they actually confirming in this letter? It sounds comprehensive.
It really is. Yeah. They formally state it's their responsibility to prepare the financials according to the rules. It's their responsibility for internal controls, including preventing and detecting fraud.
So they own it.
Completely. They state they've given the accountant all relevant information and access to records and people. They confirm they've answered all the accountant's questions fully and truthfully, that all known transactions have been recorded.
Wow.
They have to disclose any knowledge they have of actual or suspected fraud involving management or key employees, or any allegations of fraud. They confirm any known non-compliance with laws. They state whether they believe any uncorrected errors are immaterial and usually attach a list. They cover litigation, estimates, related parties, events after the balance sheet date.
The list goes on.
It does. It covers the going concern assessment information too. Basically, management puts in writing that they've laid all their cards on the table regarding the financial statements.
That sounds like a massive commitment from management. What happens if they refuse to provide this letter? Or if the accountant gets it but just doesn't trust what management is saying?
Well, that's the ultimate backstop. If management refuses to provide the letter, or if the accountant has significant doubts about the integrity of management regarding these representations,
Yeah.
the accountant must withdraw from the engagement. Period. They cannot issue a review report in that situation. It's a deal breaker.
Wow. Okay, so that letter is non-negotiable. Assuming they get the letter and all the other procedures are done, how does it all wrap up? What's the final output?
The accountant uses their professional judgment to evaluate everything they've found. If for some reason they couldn't perform all the necessary procedures, it's deemed an incomplete review. And again, no report is issued.
They need to finish the job properly.
Right. And throughout the process, they keep detailed documentation in the work papers. This shows they followed the SR standards, provides a record of their work, the evidence they gathered, and how they reached their conclusion.
But just to reiterate, that documentation wouldn't include audit-style testing or internal control work, right?
Exactly. That's a key concept. No audit test work, no internal control testing documentation in a review file.
Okay. And then comes the actual report that people see. How does the accountant communicate the results?
They issue the Independent Accountant's Review Report. It has a very specific format and wording.
What are the key parts?
It starts with the title, Independent Accountant's Review Report. Always that title. The first paragraph identifies the company, the statements reviewed, and crucially states right up front that a review is substantially less in scope than an audit and that no audit opinion is being expressed.
Sets expectations immediately.
Yes. Then there's a paragraph clearly stating that management is responsible for the statements and internal control. Another paragraph outlines the accountant's responsibility, perform the review according to SRs, aimed for limited assurance, procedures provide a reasonable basis for the conclusion, and affirms their independence.
And the big finale, the conclusion.
That's the accountant's conclusion paragraph. This is where they state the outcome, typically using that phrase we discussed. Based on our review, we are not aware of any material modifications that should be made to the financial statements for them to conform with the accounting framework.
That specific wording again.
Yes, it's standard language for a clean review. The report is then signed, dated, includes the accountant's city and state. And one last thing. Every single page of the financial statements themselves must be marked with something like See independent accountant's review report.
So readers know exactly what kind of assurance goes with those numbers.
Precisely. It links the numbers directly to the context provided in the review report.
Okay, this has been incredibly clear. So recapping the core idea, a review engagement gives you that limited assurance. It uses specific tools, mainly inquiry and analytical procedures. It's definitely not an audit, different scope, different procedures, different conclusion.
Absolutely. And if you think about the bigger picture, this review service fills a really important gap. Not every company needs or can afford a full audit.
Yeah.
So a review provides a credible, independent check on the financials that gives lenders, investors, or other users a certain level of comfort. But it's more focused and less extensive and usually less costly than an audit. It balances the need for assurance with practicality.
So for you, our listener, the takeaway is this. When you see financial statements that say they've been reviewed, you now know what that actually involved. It wasn't just a quick look, but it also wasn't the deep dive of an audit. You understand the level of scrutiny those numbers face.
Which lets you interpret those reports with a much more informed perspective. You know the boundaries of the assurance being provided.
Definitely.
And maybe this leaves us with a final thought to chew on. We've talked about different levels. Just preparing statements, compiling them, this review process, and then the full audit.
Right, a whole spectrum.
So, knowing the distinct procedures and assurance levels behind each of those labels, preparation, compilation, review, audit, how might that change how you perceive a company's transparency or trustworthiness the next time you encounter their financial reports? Which level makes you feel most confident and why?
That's a great question to ponder. It really highlights how understanding the process behind the numbers is just as important as the numbers themselves. Thanks for breaking that all down.
My pleasure. It's important stuff to understand.
Absolutely. Thanks everyone for joining us on the deep dive. Keep digging, keep questioning.